Hey, Rick.
Hey, Megan, it's Tuesday.
Here it is. It's Tuesday, and today we have a more really great, informative piece for everyone today, and that is points. Tell us about it, Rick.
Well, points are really a little known or misunderstood kind of a way mortgage loans get priced. So people talk about points. So what are points? Well, points are a function of interest rate. And so what I mean by that is the higher the points, the lower the rate. Okay, so what it really amounts to is a total yield to the secondary market investor. So points are not a bad thing, by the way, because sometimes you get a better rate. And as I'm sure we talked in the past, loans in the market are traded as what's called MBS, mortgage-backed security. So it literally is a stock. So think when you're getting a loan price, it's trading as a mortgage-backed security based on the market for that day. There's always a price to be able to get that money. Okay. I will tell you that, gosh, for years, we've done almost every loan with 0 points, especially when rates were lower, a lot of 0-point loans everywhere. As rates have moved higher this year, and especially at the levels where we're at right now, the secondary market knows one thing for sure, that the rates at this level will not stay on their books very long. And so what the investors are looking for, when I say investors, it could be secondary market jumbo investors, but principally Freddie Mac and Fannie Mae. So they price as an MBS. They're looking for a certain yield, but know that when they price those loans, they want those loans to be on the books for a certain amount of time to be able to capture that yield. And so they are pretty darn certain at this point that sometime next year they're going to see a big runoff on these. It's called the runoff. So which means people are going to be refinancing all these loans into lower rates next year. And so that runoff impacts their yield, long-term yield. Okay. And so for that reason, it's getting really, really challenging to price loans at 0 points because the market's not accepting those loans. And so what should we have to prepare buyers in this market to be really ready to pay a half point and 1 point and sometimes higher for the cost of that money. There might be times when you might find a sweet spot in the market to get to that 0 point level. But right now, for the most part, you can almost expect to pay a half point, if not higher in some cases, for the yield. Well, the good news though, we talked about this before. At some point next year, these mortgage rates will start coming down. And that won't happen until probably, third quarter, probably to get the impact of that. But rates will come down. So, but in terms of buying down the rate, that's the next piece of this, because when you're buying down that rate, what that means, of course, is we're paying more points, more cost to the loan to buy that rate down. So let's look at what the points actually mean or what they cost. So think of points as a percentage of the loan amount. So if you have a loan that's a 1 point cost and your loan amount is 600,000, well, 1 point is 1% of 600,000. So then your loan cost is $6,000 for that rate, for those points. Okay, so if the loan in the same example was a half point, it'd be a 0.5% of 600,000, which would be $3,000 in terms of dollar amounts. Make sense?
Yep.
Depending upon where the market's trading any certain day, there might be a sweet spot on a certain security, or we get a really, really good price. It's kind of weird. Sometimes you'll get a much better price by a wide margin for a rate that's just 8% lower in rate. You might get maybe a much better price. So it depends upon where the market's trading on any certain day of the week. And that's something that I look at very closely every day.
Well, good. Well, that makes sense. And I mean, it stinks, but at least we kind of know what to expect. And it's very complicated. People don't realize this whole mortgage-backed security thing and the secondary market and how the rates are controlled. People just don't, in general, have much of an understanding for that. So maybe someday we could do that. You could draw a big picture, like we're all in kindergarten, and say, here is how mortgages work.
We'll do a C-spot run.
Them. Here's where they buy them. Here's how much they are. Here's how they bundle them and sell them. And
Yeah, no, it's fascinating stuff, really. And you know, you look at how the markets work. We talked about this on some files this last week where, you know, I watch this market, as you know, very, very carefully. And we locked a couple of loans based on the data that we were seeing, and the rates went up every day after that. So we found that
Oh,
sweet
man,
spot that
I'm glad.
day, and we locked those loans. But
That was a
that is,
panic. That was a real panic.
uh,
But
yeah.
I
But
said,
you know,
just,
I'm sorry, go ahead.
I said, just listen to what Rick says and follow his advice. And
Well, I mean, I'm not 100% accurate, but
yeah, you get a
probably
good sense.
better than most. Yeah.
Yeah. So let me ask you a quick question
Mhm.
on the points. So let's say I'm buying, just in review here, let's say I'm buying $1 million house
Mhm.
and I'm putting 20% down. So my loan is 800,000.
Mhm.
So if I paid a point, that would be $8,000, correct?
Mhm.
Okay. And so how much buying power is that on my interest rate? Let's say it was a 6% interest rate at 800,000. If I paid 1 point, now what's my interest rate?
That's a great question. So I'm looking at the pricing today, for example. Um, the spread between the eighth of a percent rate, I'm looking at one right now, so it trades in basis points, which is a whole nother discussion, um, but generally speaking, the cost for every 1/8 of 1% rate is between 1/4 and 3/8 of 1%. So I'm looking at some
Could they have
market.
made this any easier to figure out? So if you spend $8,000, you could get how much off of your, if you had a 6%?
Let's assume for the moment that's a 0 point loan.
Okay, go
0
for it.
point.
Yeah,
You'd be today about, you're gonna be a 3/8 of a discount point spread between 6% and then going down to 5 and 7/8. That's pretty much where the market kind of, sometimes it's 1/4, depending upon the security, but figure really about 3/8 of 1% is a pretty safe margin. So you have to look at the math behind that, right? So if you have an $800,000 mortgage,
yeah.
let's do the math so we know. I'll do it real quick here.
Because normally if you have the choice, paying points is not worth it. Doesn't,
Not generally, no, because look, that 3/8 of a discount point on the $800,000 example is $3,000 in costs.
yeah,
So what's the savings between those two rates?
right.
Well,
So you're
the
gonna
monthly
save
savings is,
$15 a month on your
oh,
rate.
it's a lot more. It's more like $75, $80 at that price point for that loan amount.
Yeah,
Okay,
might
so
not
let's
be
say it's
too bad.
$80, right?
Let's say it's $80.
You have to be in that house for 37.5 months to get that to break even on that money.
Yeah, so it becomes a good idea at about 40 months. Like, oh, okay.
Yeah, so if you look at that though, we talked about this before. So if the rates are going down next year and you refinance that loan next year to something much lower, you lost some money there.
Right, exactly. Interesting. Well, good. Well, thank you, Rick, for that very informative discussion about points. I appreciate all of the knowledge that is in your cabeza there.
It's all
Okay,
fun.
everybody, we'll see you next week.
All right, take care, guys. See ya.